but is now in the regulations under Section 861. Those regulations say that classes of gross income consist of the items of income listed in Section 61, such as compensation, income from business, interest, etc. The regulations then refer the reader to another part of the section, which provides that a class of gross income may include excluded income. This is a slightly twisted way of saying that the items in Section 61 are not always taxable, but are sometimes excluded by law. The regulations lead to this section, which defines exempt income to mean income which is exempt, excluded, or eliminated for federal income tax purposes. The section then gives a list of those types of income which are not exempt. If the items of income listed in Section 61 come from these types of commerce, they are subject to the tax. The list, though worded differently, is basically the same list found in the older regulations defining gross income. The list includes certain foreign income of Americans, the domestic income of foreigners, and certain rules about those doing business in federal possessions. Like the older regulations, it does not include the income of the average American. Most tax professionals have never even seen this section, and those who have cannot explain it. They don't know why the regulations say that the items in Section 61 are sometimes excluded, because they don't realize that the Constitution itself exempts some income. They also cannot explain the purpose of this list of non-exempt income, and they cannot explain why the income of the average American is not on the list. This route to the truth, dealing with the issue of exempt income, independently leads to the same conclusion that we reached before when studying the specific rules for determining taxable income from sources within the United States, which was that only income from certain types of international and foreign commerce are taxable, including the domestic income of foreigners and foreign income of Americans. While the older regulations defining gross income by themselves told the whole truth about which income was taxable, back then the truth was reinforced further by the statutes giving a direct link between the general definition of gross income and the specific rules about income from sources within the United States. In the older statutes, Section 22 dealt with the general definition of gross income, and 22G told the reader that for computation of gross income from sources within and without the United States, they were to refer to Section 119, which would later become Section 861 and following. After 1954, this link vanished from the statutes, making it very unlikely that the average reader would look at Section 861 at all. To learn the history of Section 861 itself, we roll back the clock to 1925. Back then, this section of the law was only 4 section numbers away from the general definition of gross income. It said that, in the case of non-resident aliens and citizens entitled to the benefits of Section 262, certain kinds of income were to be treated as income from sources within the United States. First, we must see who was entitled to the benefits of Section 262. Under that section, citizens who received most of their income from federal possessions, such as Guam or Puerto Rico, were taxed only on their income from the 50 states, but not on their income from the possessions. As an aside, this section made it possible, though unusual, for U.S. citizens to have taxable income from within the United States, therefore allowing Section 1.1-1 to truthfully say that citizens are taxed on their taxable income, whether from sources within or without the United States. Only those receiving income from federal possessions were entitled to the benefits of Section 262. Therefore, according to Section 217, in the case of non-resident aliens, and in the case of citizens who receive most of their income from federal possessions, certain types of income, such as interest from the U.S. and compensation for services performed in the U.S., were to be treated as income from sources within the United States, and after subtracting deductions, were to be included in full as net income, or taxable income, from sources within the United States. 3 distinct criteria had to be met in order for income to be taxable under this section. First, one had to be engaged in a certain activity, namely a non-resident alien getting income from the U.S., or a citizen getting income from federal possessions. Back then, another section of the statutes showed that the rules in Section 217 also applied to foreign corporations and domestic corporations with possessions income, so we will add those to the list of specific activities. The second criteria was that some item of income was received, such as interest, dividends, compensation, etc. The third criteria was that the income came from inside the U.S. Only when all 3 applied did the section show income to be taxable. While one might wonder what other sections might say, it is absolutely clear that this section did not say that the domestic income of most Americans was taxable. It said that for foreigners, and for certain Americans who also receive income from federal possessions, income from within the United States was taxable. There is a principle of law which, translated from the Latin, roughly means the inclusion of one implies the exclusion of all others. When a law specifically says that it covers certain matters, it is to be assumed that it does not cover all the things which are not specifically mentioned. For example, when the older statutes specifically said that domestic income was taxable for foreigners and for citizens who also received possessions income, it is a mistake to assume that it is taxable for all other U.S. citizens as well. As the Supreme Court said, in the interpretation of statutes levying taxes, it is the established rule not to extend their provisions by implication beyond the clear import of the language used, or to enlarge their operation so as to embrace matters not specifically pointed out. The court also added that in case of doubt, taxing statutes are to be construed most strongly against the government and in favor of the citizen. Moving forward to 1939, we see that this section remained basically the same, except that the first phrase simply vanished. The section no longer said that it was only about foreigners and Americans who receive possessions income. It now seemed to say that all income from inside the U.S. was taxable. Was this a drastic change in the application of the law? Had all domestic income become taxable for everyone? No. While the statute no longer mentioned the specific activities, the related regulation still began by saying that the section was about non-resident aliens, foreign corporations, and U.S. citizens and domestic corporations receiving income from federal possessions. The statutes talked about items of income and the geographical origin of the income, but numerous sections of the regulations still showed that domestic income was only taxable for those engaged in specific activities described in other sections of the code, now called operative sections. For example, the general wording of the statute seemed to say that all interest from the United States constituted gross income, but the related regulations clearly stated that interest from the United States was to be included as gross income when received by non-resident aliens, foreign corporations, and Americans who also receive possessions income. The regulations about taking deductions and determining taxable income also were plainly only about those engaged in these specific activities. As the years went by, the sections of regulations showing the truth began vanishing from the law books. But bits of truth still remained in 1954, when the code was renumbered and rearranged. The old Section 119 became Section 861 and following, which have remained essentially the same since. Congress specifically said that the application of this section did not significantly change in 1954, but there were significant changes in the wording of the related regulations. Perhaps the most significant change occurred in what is now Section 1.861-8, the section for determining taxable income from sources within the United States.